Every country swears its central bank has things under control. Every politician loves to promise stability, predictability, and confidence in the system. The language never changes. Our currency is safe. Our economy is solid. You can trust the institutions. And then there are days when all of that evaporates in an instant. On the morning of January 15th, 2015, traders around the world sat down at their screens expecting another quiet day in one of the safest currencies on earth, the Swiss franc. For years, the Swiss National Bank had drawn a clear, unshakable line. €1 would never be worth less than 1. 20 Swiss francs. That was the floor, the peg, the guarantee. The central bank had promised to defend it with utmost determination. Then, without warning, the peg snapped. In a matter of minutes, the franc exploded in value. Currency pairs moved 20, 25, 30% in violent, jagged spikes. Charts that usually looked like calm rivers suddenly resembled heart monitors during a cardiac arrest. Billion-dollar brokerages went insolvent. Retail traders were wiped out. People with Swiss franc-denominated mortgages suddenly owed far more than they did the night before. The currency that symbolized stability delivered one of the most brutal shocks in modern financial history. A small, wealthy country changed a single line in its policy. And that was enough to rearrange savings, bankrupt firms, and rewrite thousands of financial contracts across continents. So what actually happened when a peg snapped? And what does that moment reveal about the financial system that quietly shapes everyday life? For most of modern history, the Swiss franc has been a refuge. When the world panics, money runs to Switzerland. Wars, crises, inflation scares, debt defaults. Again and again, frightened capital has flowed into a country known for political stability, conservative banks, and for much of the 20th century, strict financial secrecy. The result has been a currency that people feel they can trust even when they don't trust their own government. That reputation sounds like a pure blessing. But for a small, export-heavy economy, a super strong currency can become a slow, grinding curse. By 2011, the Eurozone was in crisis. Greek debt dominated headlines. Investors feared that the single currency project might tear apart under stress. Each new negotiation, each failed summit, each rumor of default sent anxious money searching for shelter. Where did it go? Straight into Swiss francs. As money flooded into Switzerland, the value of the franc jumped. That was great for anyone holding Swiss cash. It was much less great for Swiss businesses trying to sell goods and services abroad. Watches, precision machine tools, pharmaceuticals, financial services. Suddenly, everything priced in francs looked painfully expensive to the rest of the world. For Swiss tourism, the country became not just beautiful, but brutally overpriced. Jobs, profits, and growth were all at risk. The Swiss National Bank decided to act. In September 2011, it announced a radical move. It would not allow the euro to fall below 1. 20 Swiss francs. If market forces tried to push the franc higher, the central bank would step in, create francs out of thin air, and buy as many euros as necessary to hold the line. The message was simple. Bet against this floor, and you are betting against the Swiss central bank itself. In effect, Switzerland chained its currency to the euro. On paper, it looked like a clean solution. In reality, it was like bolting a small, well-built lifeboat to a much larger ship that was already taking on water and promising to keep both afloat no matter what. To understand why that was so dangerous, it helps to understand what a currency peg really is. A peg is not magic. It is a promise. A government or central bank stands up and declares to the world, our money will be worth this much relative to that money. We will not allow it to move beyond this line. It sounds comforting. It sounds like order imposed on chaos. But underneath that promise is a constant battle between markets and policy. History is full of pegs that failed under pressure. In 1992, the United Kingdom kept the pound in the European exchange rate mechanism, promising to hold its value inside a tight band relative to the Deutsche Mark. Speculators tested that promise. To defend it, the Bank of England had to raise interest rates and spend reserves, hurting the domestic economy. Eventually, the cost became intolerable. The peg broke. The pound crashed. Traders like George Soros made fortunes. The central bank was left with a damaged reputation. Argentina, in the late 1990s, is another grim lesson. Its leaders pegged the peso 1-to-1 with the US dollar. For a time, this looked like discipline and modernity. But the peg forced Argentina to pretend it was as strong and stable as an economy many times its size. When growth faltered and debt piled up, the country could no longer maintain the illusion. The peg collapsed. Savings evaporated. Rage spilled into the streets. The pattern is clear. Pegs work until defending them becomes too painful. Every peg is a bet that the defending institution can withstand whatever pressure shows up, a bet that people will continue to believe the story long enough for conditions to improve, a bet that politics will tolerate the cost. In Switzerland's case, the bet looked safer than most. A small, rich country with a strong balance sheet, a conservative central bank, and a reputation for competence. What could go wrong? From 2011 to 2015, the Swiss National Bank fought a quiet, relentless war against market forces. Each time fear spiked in Europe and investors dumped euros, the franc came under upward pressure. Each time, the SNB had to create new francs and use them to buy foreign assets, especially euros, to keep the exchange rate pinned. The more the world doubted the euro, the more francs Switzerland had to create to support it. The central bank's balance sheet swelled. It accumulated hundreds of billions in foreign currency reserves, euros, dollars, government bonds, and even equities. For a country of just over 8 million people, the central bank turned into a financial whale, quietly becoming one of the largest asset owners on the planet. On the surface, everything looked calm. The EUR-CHF chart was oddly flat, hovering near 120 like a machine-controlled heartbeat. Traders grew used to it. Businesses signed long-term contracts, priced exports, and wrote models assuming the floor was permanent. Risk managers grew comfortable. Many retail traders saw the peg as a kind of free lunch. Buy the euro near the floor, set tight stops, collect small profits, repeat. But that calm was an illusion. Behind it, pressure built like water behind a dam. In 2014, the European Central Bank signaled a new, aggressive phase of monetary policy. Negative interest rates, massive bond buying programs, and the possibility of open-ended quantitative easing. In simple terms, the ECB was preparing to push the value of the euro down to stimulate the economy. That created a brutal dilemma for Switzerland. If the euro weakened sharply, defending the 120 floor would require the SNB to print even more francs and buy even more euros. Its balance sheet, already enormous relative to the size of the Swiss economy, would have to expand to levels that made policymakers deeply uncomfortable. On paper, the Swiss National Bank had promised unlimited intervention. In reality, unlimited interventions do not exist. There are always limits: political limits, legal limits, psychological limits, and the quiet fear that a central bank might lose control of its own money. At some point, the numbers on the balance sheet stop feeling abstract and start feeling dangerous. By early 2015, the SNB was cornered. It could keep the peg and risk accumulating even more euro-denominated assets that might fall in value, all while inflating its own money supply. Or it could abandon the peg and unleash a shock. On January 15th, 2015, it chose the shock. The announcement was abrupt. A short statement declared that the minimum exchange rate of 20 francs per euro was no longer justified. The floor was gone. In the same breath, the central bank introduced even more negative interest rates, but that detail hardly mattered in the chaos that followed. Within seconds, the market went haywire. The euro plunged against the franc. Some trading platforms showed prices spiraling from near 20 to parity and lower. Liquidity vanished as banks pulled quotes. Many of the stop-loss orders that traders believed would protect them simply did not execute at anything close to expected levels. Charts printed enormous gaps. The safe currency behaved like a penny stock hit by a panic. Retail traders, many of whom had used heavy leverage on the assumption that the peg made the franc predictable, saw their accounts obliterated. Balances went not just to zero, but deep into negative territory. They did not just lose their money, they now owed their brokers money. The damage rolled uphill. Several brokers had marketed guaranteed stop losses. Others had skewed exposure. When prices gapped beyond their risk models, they absorbed gigantic losses. Some firms went insolvent. Others needed emergency capital injections to survive. Regulators opened investigations. Lawsuits followed. The shock wasn't just a story of traders and charts. In countries like Poland, Croatia, and Hungary, hundreds of thousands of ordinary people had taken out Swiss franc-denominated mortgages and loans. For years, those loans had seemed smart. Interest rates in francs were low. Swiss money felt solid and stable compared to local currencies. Marketing material emphasized safety, not risk. After the peg snapped, local currencies fell sharply against the franc. The amount owed on those loans, when translated back into salaries and local money, jumped. Monthly payments ballooned. Some households saw their effective debt rise by double digits overnight, without ever borrowing a single extra cent. Families woke up to find that a decision made by an unelected board in another country had suddenly reshaped their financial future. That is what it looks like when a peg breaks. Savings erased, balance sheets crushed, models shredded, lives disrupted. The official explanation for the Swiss decision emphasized cost. Maintaining the floor in the face of a weakening euro, the SNB argued, would have required increasingly massive interventions. The risks were growing. The policy was no longer sustainable. There is truth in that. But underneath the technical language is a simpler reality. A peg is only credible as long as it suits the institution defending it. Central banks enjoy speaking about commitment, forward guidance, and credibility. They insist that markets should trust their words. Yet the moment the cost of keeping a promise rises beyond what is politically acceptable or psychologically tolerable, those same promises become negotiable. The rules change. The line in the sand is redrawn or quietly erased. In 2011, defending the floor served Switzerland. In 2015, removing it served Switzerland more. The interests of those who had built their lives or strategies around that floor were secondary. Seen that way, the Swiss franc shock was not an anomaly. It was a reminder. Throughout history, promised exchange rates, guaranteed convertibility, fixed gold parities, and solemn assurances have broken whenever the pressure became too great. The gold standard was once sold as an unshakable anchor. In practice, countries suspended it during wars, depressions, and crises. The British government abandoned the gold standard in 1931 when defending it meant inflicting intolerable pain on the domestic economy. The United States ended the dollar's convertibility into gold in 1971 when foreign claims on American gold became uncomfortably large. Each time, the promise lasted only as long as it was convenient. The British pound in the ERM, the Thai baht before the Asian financial crisis, multiple Latin American currencies tied to the dollar, all tell the same story. A peg creates a fragile equilibrium. Strong political words and technocratic confidence conceal growing tension. Once the strain reaches a certain point, the currency regime breaks. Those who trusted the official story most are usually hurt the most. The Swiss case felt different only because it happened in a country that symbolized caution and conservatism. If a central bank with that reputation can walk away from a floor it swore to defend, it becomes harder to believe that any promise in finance is sacred. What survives when pegs snap and promises fail is not the reassuring narrative. What survives are underlying realities. How competitive an economy truly is, how sustainable debts truly are, how much hidden leverage has built up in the shadows, how exposed households, companies, and financial firms are to sudden changes in prices. For traders and investors, the lesson is uncomfortable but straightforward. A policy line on a chart is not a law of nature. A central bank saying, "Oh, we will not allow this," is not gravity. It is a statement of intent, valid only until conditions change. For ordinary people, the lesson is more subtle but just as important. Every long-term financial commitment rests on some kind of assumption about stability. A mortgage in a foreign currency assumes that exchange rates will not move violently. A pension scheme assumes that governments will honor promises. A savings account assumes that inflation will stay within a range, that banks will remain solvent, that deposit guarantees will be honored. Those assumptions are forms of trust. They can hold for years, even decades. Then, in a single announcement or a single crisis, they can vanish. The world today is filled with new kinds of pegs, some visible, others psychological. Interest rates are held near certain levels as a matter of policy. Bond yields are kept inside corridors. Entire markets behave as if central banks will always step in to cushion every serious fall. Investors speak casually of the central bank put, the belief that monetary authorities will not allow asset prices to drop too far. Governments and institutions insist they will not permit defaults, collapses, or crises in certain sectors. Depositors believe that if a large bank fails, the state will step in. Citizens assume that major countries cannot truly default on their debts, that inflation will not spiral, that currencies in developed nations cannot behave like those in struggling economies. All of these are in their own way pegs. They may not be formal exchange rate bands, but they are mental floors, implied guarantees, unspoken promises. The Swiss franc shock offers a clear reminder. What looks safest can sometimes be the most dangerous, precisely because safety encourages complacency. The calm period, when charts move in narrow ranges and institutions repeat their commitments, is often when hidden risk grows the fastest. Leverage increases. Businesses and households adjust to a world where certain outcomes are treated as impossible. Then the impossible happens. And when a peg snaps, the event is more than a violent chart. It is a transfer, from those who believed the story completely to those who doubted it, from those who sat comfortably on promises to those who quietly prepared for their failure. From those who assumed tomorrow would look like yesterday to those who studied history and recognized the pattern. The shock of January 15th, 2015 showed how quickly trust can be repriced. The central bank changed its mind. Markets, brokers, and families paid the price. When looking at personal finances, that is the question worth asking. How much of current security depends on the assumption that someone else will always keep a promise, forever, no matter the cost? History's answer is consistent. Promises in finance are rarely absolute. They are conditional, situational, and reversible. If this gave you a new perspective, hit subscribe. History has the answers, if you know where to look.